Have you ever looked at a big company, maybe an airline with a ton of brand new planes, and wondered how they put all that on their books when they don't actually own them? Well, it all comes down to lease accounting. And today, we're going to break down exactly how to calculate and record a lease step by step. So, let's get right into it.
First, we're going to set the stage with a pretty straightforward lease scenario. Then, we'll jump into the numbers and figure out the present value, which is the key piece of the puzzle. After that, we'll walk through the actual journal entry to get it on the books. And finally, we'll talk about why this whole process is so important for understanding a company's real financial situation.
All right, first things first. Before we can do any math, we need a situation to work with. So let's set the stage.
So, just picture this. There's a company, it needs a bunch of delivery vehicles to get its products out the door. But instead of buying them all, which is a huge cash outlay, it decides to lease them. And the key date for us, the starting line for all our accounting, is June 30th.
Okay, so here are the nitty-gritty details of the deal. The company has to pay $40,000 right up front. Then they've got 6 more payments of $5,000 each, and they'll pay those every quarter. The whole lease lasts for 2 years. Now, baked into this deal is an 8% annual interest rate. We call that the implicit rate. And at the very end, they just hand the keys back. These numbers right here, these are all the ingredients we're going to need.
So we have all these payments happening at different times in the future. How in the world do we turn that into one single number that we can put on the balance sheet today? Well, that is where the magic of present value comes into play. Let's see how it works.
You know, the concept is actually pretty simple. $1 in your pocket today is worth more than $1 someone promises to give you next year, right? Because you could invest today's dollar and earn interest on it. Present value is just the tool that lets us calculate what a series of future payments, like those 6 lease payments, is worth in today's money.
So, if you were to pull out a financial calculator, here's what you'd punch in. For N, the number of periods, that's easy. It's our 6 quarterly payments. Now for the interest rate, or I/Y, you got to be careful. We need the rate per period. So we take that 8% annual rate and divide it by 4 quarters, which gives us 2%. The payment, PMT, is that $5,000. And FV, or future value, is 0 because there's no big final payment at the end. You hit compute for present value and boom, $28,007. So the key thing to remember is this is really just a 2-step process. First, you have the present value of all those future payments, which we just figured out is $28,007. Then you just add the initial payment of $40,000. And since that was paid today, it's already in today's dollars. No extra calculation needed for that part. Easy.
And there we have it, $68,007. This number is so important because it actually represents 2 things at the exact same time. It's the value of the asset the company gets to use, what we call the right of use asset, and it's also the total debt it just took on, which is the lease liability.
Okay, we have our number. Now it's time for the really satisfying part, making the official accounting entry to get this whole lease onto the company's financial statements.
And here's what it looks like. On the debit side, which is what the company gets, we record a right-of-use asset for the full $68,007. That's their right to use those vehicles for the next 2 years. Then on the credit side, what they gave up or now owe is the $40,000 in cash they paid out, plus a brand new lease liability of $28,007. That's the present value of what they still have to pay.
So, we've done the math, we've recorded the entry, but why do we even bother with all this? Let's just zoom out for a second and look at the big picture.
At the end of the day, this is all about one thing: honesty, transparency. Think about it. It wasn't that long ago that companies could have these massive lease obligations. We're talking entire fleets of jets or hundreds of store locations that were basically invisible to investors. They were kept off balance sheet. This made companies look way less in debt than they actually were. The new accounting rules force all of this out into the open, giving everybody a much truer picture of what a company is using and what it owes.
And that brings me to one last thing to think about. Our example was pretty simple. But what if the deal was a little different? What if the company had promised that the vehicles would be worth a certain amount of money at the end of the 2 years? Well, that promise, that guaranteed residual value, would have to be calculated into the present value, and that would change both the asset and the liability on the books. It just goes to show you how one little tweak in the terms can really change the financial picture.